Gene Turk. I am the Vice President of Business Development at Align and the Scaling Up Scoreboard. And I want to welcome you to our February Coach webinar. This morning, we are thrilled to have Coach Rich Manders with us with a presentation entitled Sparkle, 7 Proven Steps for Creating a More Valuable Company. For those of you who are not familiar with Rich, he is a serial entrepreneur, lifelong learner, and a student of business. He is currently a Scaling Up certified business coach and one of the co-founders of the Freescale coaching system located in Cambridge, Massachusetts. Rich is in that role. Rich is dedicated to helping other CEOs and their leadership teams scale their businesses and their personal freedom simultaneously through coaching and development. Before becoming a business coach, Rich co-founded and managed iAutomation and took it from $0 in sales to become the industry-leading company with approximately 160 employees and $80 million in sales. He has been a part of several acquisitions and dozens of evaluations on both the buyer and the seller side. And through those experiences possesses a deep understanding of how to value, assess, merge, optimize, and grow combined enterprises. He is a former board member of the EO Connecticut and EO Boston chapters and is a regular speaker to large audiences of business leaders at institutions like Harvard Business School. Before we begin, just as we do every month, one administrative matter of housekeeping. We always want this to be as educational and informational for all of you as possible, so please do not hesitate to ask questions, but please do so using the Zoom chat feature, and we will ask Rich to try to answer as many of those questions as he can at the conclusion of the presentation. So again, thank you to all of you for attending this month's Align Coach webinar, and we will now turn the microphone over to Rich. Thanks so much.
Thank you, Eugene, and thanks for the opportunity to speak to everybody. Before I dive in, I wanted to say thank you. And secondly is I created this talk around a program which was how to maximize your business for value at exit that I did at Harvard. But I want to preface before I even dive into this that every single thing that we're going to talk about here, let's just say you're not going to sell your business, so that's not your end game. It's okay. All of these things that we're going to talk about are great for your business, even if you're going to keep it. And so I just wanted to preface it with that. As Eugene mentioned, I've got a background. They altogether exited 7 companies, 3 as a founder, and the last one, which I'll talk a little bit about, iAutomation, was a home run. And during the time that I was involved with private equity, I was involved with many other deals as an advisor or a commenter on whether a deal was a good deal or not. So I've seen many, many dozens of deals go through that ended up going through, and what works and what doesn't, and what are the factors that drive your valuation. So quick snapshot into the iAutomation story. We started planning it in 1997. This is a picture of our distribution facility in High Point, North Carolina. The company started in Boston and Hartford, and we kicked it off as a startup, no customers, and start with a cold start, and grew it to about 12 million in revenue by 2007 from 2008. And then we recapitalized it. So we brought in a partner. We sold 75% of the company to a private equity partner. During that cycle, we ended up with 8 bidders for the company, and was able to pick from the best bidders and use them against each other. Once we got on that path, we started on the journey of growing the company to the next phase, which involved using the private equity fund that we work with, which was an amazing company, a company called Riverside. We were, I think, the 300th company they had acquired by the time they got to us. They're about an $8 billion fund. And they had an amazing infrastructure to teach us how to build value in a business. And a lot of what I'm going to talk about is around that. From that run from 2007 till 2017, we grew the business about 8-fold. We hired our replacements, which is an important part of the equation. And we we did a number of acquisitions, and we were able to, in the end, sell it at the end of 2017, or at the beginning of 2017, and make all of our investors roughly 5 times their capital back, which worked out to be a 40% annual return on the business. So this stuff really works. And again, when we went to market the second time, we ended up with 12 bidders for the business that fought over the business and drove the multiples up very, very high. And so that resulted in a great outcome. So that's iAutomation. And I was lucky enough that with that sale, we were financially independent. We did exit the day-to-day of the business at the end of 2012. So we were really free from running the day-to-day of the business, stayed on as advisors, owners, and board members beyond that. Okay, so our goal was to grow our business and get to financial freedom. So the question is, how did we do it? How did we learn how to get to this spot? And the first thing was we found mentors. So this guy, Vern Harnish, most everybody probably on this call knows who he is. I went to a seminar of his in 1998 and learned about the Rockefeller habits, which eventually became scaling up. And we started applying those principles in the business with the idea, and Vern will tell you, to get to 3.5 times the industry profitability, which gives you lots of choices. So we went after that with wholeheartedly following all the stuff that was in there, which was the X Factor and the BHAG and all of those things to make things happen. And my business partner, Wayne, in this picture, and we started implementing these things. And so the first thing that helped us really get this company off the ground and growing was actually something you wouldn't have thought of. So we learned, we went back to the company and taught what we learned, and we did okay, but not as good as, we weren't getting to that 3 times industry profitability. So I went back and I called Vern and I'm like, it's not working like you told me. And he's like, tell me what you did, Rich. And I told him what I did, that took the plan that we created with him and took it back to the team. He's like, no, you're supposed to include them in it. And so what we ended up doing was sticking our whole company in a 15-passenger van besides Wayne and I, and sending them down to Vern's 3-day scaling up thing with instructions on how that you need to come back with a plan, and here's the outcomes we want. And once we introduced them into the planning process, the 15 or so of them, they came back and it was their plan. It was better than our plan because they were closer to the customers and more connected. And that's what really drove us forward. The other part that I want to push as part of this was we really focused on education with our company. And so we had sent people to all kinds of seminars and programs. We belong to all kinds of peer groups and learning facilities, so EO, YPO, the Gazelles, et cetera, along the way to get to where we want to be. So what in the world is Freescale? Freescale is a system that helps the CEO and the leadership team scale their business while scaling themselves and their freedom at the same time. So when people are building a business, they generally have a plan, and the plan looks something like this, right? Over time, my revenue is going to go up and to the right. This is exactly how it works for you, right, Eugene? Right, and everybody else on. This is our plan, right? We've drawn this out, and it works out, and we think it's going to work great. The reality, and many people may have seen this slide, is this is kind of what it looks like. So we have a plan, but the real reality is there's lots of bumps in the road, and we were no exception to that. We had global financial meltdowns twice during our whole time in the company. We had employees leave, vendors leave, lawsuits, you name it, right? Where we had to get through to figure it out. But more importantly, when you think about a business, most people start a business because they want freedom. They want to get to a spot where they have freedom, financial freedom, freedom of choice of what they do, freedom from their boss that they don't like, etc. But the reality is, for most folks, when you start a business and you embark on this, is that actually the more the business grows, the more your freedom goes the other way. And so I started thinking about why this happened. And as we were in the side of buying businesses and looking at businesses to buy, what we saw was that there was a number of people that we were able to buy their companies at a very discounted price from what their real value was, because they didn't understand this phenomenon. They didn't understand how they were stuck. So I'm going to flash a picture up here on the screen. And if you know what this is, type it into the chat box. I'm going to give you a second. See if anybody knows what the name is for that or what that is. Anybody responding, Eugene?
They are not.
Okay, so probably nobody knows, but they probably say, I've seen this somewhere, and this is where it comes from. It's called the Plisoll Line. And when you build a cargo ship, they put this line on the side of the ship, and it says, how much cargo can you put in until the boat is sitting down in the water to the line, and then you have to stop adding more cargo. And if you notice, the definition of the line at the top of the line is tropical freshwater load lines. That means in calm seas, in the Caribbean, in non-hurricane season, you can load this boat down with all kinds of weight and it's going to be fine, because it doesn't have to operate in heavy seas. And the line at the very bottom, winter in North America, is a terrible place. I live in North America, and you do not want to be in the ocean in February. It's a terrible place to be, so you can't put much weight in this boat. And the boat is a metaphor for your business. And the more your business has challenges, the less weight you can put in. And those challenges are the weather, if you want to use that same idea. So I want you to think about, how can you build your boat to operate with carrying more weight in heavy seas? I'm going to show this little chart here, which comes from one of our clients, a company called Acceleration Partners. He did a great job of describing this phenomenon. So if you look at this chart, this line right here is the company growth rate. So this company's growing, let's call it at 30 or 40% a year. And what happens is that the people inside the company, if you're not training and developing them, cannot keep up. So as the company's growing, you see that the responsibilities for the role, so this is an individual contributor down here, then you become a manager of people, then you become a director, then maybe a VP, then etc. along the way. Oops, went too far. And what happens is that some people in the company can keep up, right? So they're able to keep up with the line. That's it. I'm going to define that as an A player. Then you have some people who are struggling to keep up as the complexity of the work goes up. You're managing more people, more customers, more processes and systems, that you start struggling to keep up with the growth. So those are hard choices. You have people who are underperformers, they're easy. And then you, of course, have stars, which are able to get through all of these challenges. The big point is that as the company's growing, the needs of the company become more and more challenging for the people that you have. Sometimes you can get around this by hiring people with experience. Sometimes you can get around this by developing training programs. But this is true not just for people, but it's also for your systems and also for your marketing. For example, a company, when you first start, the challenge is to add maybe 2 or 3 or maybe 10 customers a month. But as the company grows and that goes to 100 customers a month and then 1,000 customers a month, the same way that you acquired customers won't work anymore. At 10 customers a month, you probably can do it by knocking down doors. At hundreds of customers or thousands, you're going to need systems and infrastructure. It's going to be true for your processes, your CRM and your resource planning software and your scheduling software. All that stuff that works great when you're little won't work. And so you have to think about all of these structures and how they go. So if you think about a business, when you're above the Plisoll line, right, you can work on the business, right? You can be strategic, you can coach and develop people, you can be focused, you are able to think long range, you give feedback and get feedback, you're developing new ideas. essentially strengthening the core of the business, being able to develop this capacity that's here. And when you get above the line, you start making mistakes and you start really getting into this firefighting mode, which is a very big challenge because you're not fixing problems in the long run, you're just patching things. And so you feel overwhelmed, stressed, panicked, etc. And so in a short, the way I look at it is, if I'm working in the business, I'm not free. If I'm working on the business, I am free. And I'm going to talk a little bit about that. So what does free look like? Free looks like you have clarity about where the company's going. You have certainty, you can predict where the business model's going, and you have choices. It's the business is fundable, or you can sell it, or customers are banging down the door to get to you. That's what free looks like. And what scale looks like is being durable, investable, having A players, so amazing people, and having a rhythm or a pattern so that you have a strategic respiration. You're constant. There's a time to talk about different things, and it cascades up and down through the company. So we had figured out some of these things when we had brought in the private equity partner, and Riverside, as I mentioned, is now a 30-year-old company that's done over 500 acquisitions, and over that whole time, they've returned on average 2.5 times the capital back to the people who invest in them. So roughly 25% a year on your money. So what they taught us was this framework called Sparkle. And so when they acquired our 75% of our company in 2007, they said, here's the framework that we use to build value. Look at our results over the last 20 years and apply this to your company and build a scorecard. So I'm going to walk you through this framework and give you some ideas about what you might want to focus on to build the capacity of your business and build the value of your business, so that either it's very fundable, you can go out and get more money, or it's throwing off lots of cash, which provides you with personal freedom, or it's highly valuable to somebody else to buy it. And besides that, all of these things make your business easier to run and easier to develop over time. So this is the Sparkle framework. Okay, so the Sparkle is an acronym, so each letter stands for something. And so the first one is, in order to get your business to maximum value, it has to be scrubbed and clean. What do I mean by that? I mean that you have to have everything in order so that it's easy to find things, easy to operate, and operating within the bounds of the law. So let's talk about some of the things that I've seen screw up companies along the way. The first one is your legal agreements. So if you have partners, do you have a partnership agreement? Do you have buy-sell? Do you have best man insurance, right? All of those things. What about our employee agreements? Do they have non-compete clauses? Do they have clear lines of responsibility? Do they have scorecards so it's clear when they're performing or not performing? Relationships with our vendors. This is one that killed us a few times along our journey, was we had vendors that we were very dependent on, that our contracts with them were either we didn't have any, or were very much favored in their size. When you're a startup, you say yes to everything. And so getting these vendors to work with us, we were thrilled to have them, and we'd sign any agreement they sent us. But when it came time to sell the company, these were problems that a buyer was looking at and going, wait, you can get canceled at any time, and wait, they can raise the prices at any time, and wait, right, on and on. Same thing with real estate. If you own it, how is it connected to the business? If you're renting, what are the status of your leases, and so on. And I'm going to give everybody a copy of this presentation with the notes so that they'll see all the things I'm speaking about. So you don't have to write down like crazy. I'll give you an outline at the end. So those are all the things around the agreement. The second section is your books. You don't want hanky-panky on your books, right? You don't want stuff that you have to explain away. Many times when you're a startup and then you start making some money, you start running things like your boat or your airplane or your company or your vacation cabin through the company, paying for your kids' health insurance. You got to clean all that stuff up, because all of those things are going to be things that hurt you in the sales or recapitalization process. The next one is inventory. Make sure you're being real about your inventory. This is a place where we've found, when I was an acquirer of companies, I've extracted millions and millions of dollars of value out of companies that didn't do these things. And so I'm giving it from the real perspective. Make sure your inventory is real. It's not obsolete. Somebody's going to buy it. The next one is HR compliance, making sure that you have a list that all of your HR policies are being followed, that you have the right insurance, that you're up to date with all of those things. Find a good firm to work with if you don't have the talent in-house. The next one's receivables. Carrying receivables on the books that are over a year or two old is not gonna, they won't get counted towards your value. Things like sales tax. I've had 3 forum mates from my time in EO and YPO that have had to pay multi-million-dollar settlements because they didn't properly collect sales tax in places where they had nexus. And so you want to make sure that you have a good tax attorney working with you to make sure that this stuff doesn't come back to you. And here's one that cost us over $500,000 is technology. Do you have the licenses for the technology that you're running? So when we were, the quick version of the story is when we were running a startup and we had half a dozen employees, what we did was we went out and bought Microsoft Office Student Edition for everybody. And that little process continued to run as we grew past 20 employees, past 40 employees, past 100 employees. And when we were going to put the company up for sale, and we started getting due diligence on us, they said, wait a minute, your EBITDA is not true because you don't have the right licenses for your software. We didn't have the right server software. We didn't have the licenses for all of the instances of Microsoft Office. We didn't have enough licenses for our operating system, which was at that time called Peachtree Accounting, et cetera. So that stuff just kills you. All of those things are going to get you a haircut. So you want to get scrubbed and clean. The next one is you want to have a powerful management team. People are buying not just your cash flow in most cases, but that you have a team that can take your company to the next level. So any critical players you have on your team, you should have backups identified for that are on a internship or wizard's apprentice program where they're learning from the person that's their boss. You also want to have a virtual bench. You want to be talking to other people in your industry, having people on tap in case somebody gets taken out by the proverbial bus or just growth needs. It often takes many years to hire people, the right people, because they have a job and you've got to convince them to leave it to come to you. You want to make sure that you have all your processes documented. Probably the most important thing, and you're probably doing this with Align already, but I just want to double down on it, is have your one-page strategic plan done, and so that everybody has line of sight of how what they're doing is contributing to the team. When we were selling our company, this was the first time in 2007, every person in the company, all 30 or so, had a one-page strategic plan on the wall of their cubicle. And if you work with the one-page strategic plan, the last column, is you and what you're doing and how it ties to what the company's focused on this quarter, this year, this 3 to 5 years, and in the long haul. And that was a big part of what got us multiple bidders for our company. Was we just let people walk around the company and talk to anybody. And the shipping clerk and the receptionist had a one-page strategic plan for themselves, as did the CEO and the leadership team, right, from top to bottom. So making sure that everybody has it. And then lastly is you want to lock in these employees. So stay bonuses, some kind of phantom stock options, et cetera. But you want to have a lock that keeps these people tied to you in a positive way, so that when they look at the team, they don't see flight risk when they're looking to buy your company or invest in your company. The next one is attractive facilities. This seems like it's, but the reality is, having been with Riverside, during my time with Riverside, we went and looked at a few companies. When you see these places and they're a mess, right, that there's piles of paper everywhere, stuff stacked in corners that's, the warehouse is a mess, etc. There's a saying that says, how you do anything is how you do everything. And so when you walk into a company and you look around and the place looks like a disaster, chances are there's all kinds of ticking time bombs buried underneath all those piles of paper, stacked up inventory in corners, etc. So it's really important to make a good impression. Modern equipment, clean, and looking like a place that people would want to work. Really, really important. The next one is for R is rising diversified revenues and margins. And so what you're looking for is ratios here. So what's your ratio from your largest customer to your smallest? If you've got customers that are 10, 20, 50% of your business, that's going to be a challenge. You want to look for where are you getting improvement over time on your margins? Are you making more money as a percentage as the company grows? Those are things that tell you that a company is running well. As part of us, when we work for Riverside, we were more incented on squeezing more margin dollars, net profit dollars out of revenue, more so than growing top line, because that's showing that you're getting business efficiency, your customers are buying into your value proposition, and you're gaining market share. Those things, and so that is by far the #1 indicator that you're making traction in your marketplace. So looking at margin, top and bottom line is really important, and having power to make that happen. Okay, we cheated a little bit on the K for Sparkle. Should be a C, but isn't spelled that way. But a clearly articulated value proposition and growth plan is critical to your success in having a business that's going to be highly fundable. So things that you want to have to hit this are, first of all, you want to have a really clear core customer. Where are they? Where do we find them? What's their job title? How many of them are there? Where are they located? So that you can say, we've got this business, it's been growing steadily, but look at the marketplace out here in the distance. We've only tapped a small share of market. There's so much more to get. And building that out and having that as a story. So when Riverside was looking to buy us, they called our customers and asked them about our value proposition. You should be ready that all of your top customers should expect a call from a buyer saying, why do you buy from them? Who are the competitors? What do they offer you? What makes you stick around? What would make you leave? Asking those kinds of questions. The best indicator for this is measure your net promoter score. Ask your clients and have them give you feedback on net promoter score. That I could do a whole webinar on that, but look it up if you don't know what it is and learn about it. It's the best way to know that you're heading in the right direction. You want to get market data. If there's trade associations where you are in the industry that you're in, go out and find what's the size of your market, and what, in the sandboxes that you're going to play in, how much additional market is there to grab. Because what they're looking for, if you're going to sell, is if I pour money and resources into this company, how fast can they capitalize on this remaining market? So showing a big giant marketplace. In 2007, we had about 5% market share in the regions we operated in. So we knew we could grow significantly more and had the evidence to back that up. That was really important. And a great way to articulate this is business model canvas. So being able to lay this out. So that's a tool that you should look up and pay attention to. Okay, we're almost to the end here. Excellent preparation is the next one, right? So you want to make sure that you have a lot of data on the levers inside your business. There's a video out by this guy, Peter Filippi. It's Strategic is the company, STRATEGEX, that talks all about the 80-20 principle and which of your customers are you making money on and which segments are you not, and what's your plan to drive the company towards the profitable customers. And that means that you have to have the data on profitability. one of the biggest investments we made was in a system called Return on Time, where we were able to allocate everybody's time in the company against the customer. But that allowed us to look at and see what our customer acquisition costs were, what our cost to maintain a client was, and where we fit into the marketplace. And armed with that knowledge, we were able to craft our offering to totally knock it out of the park for these clients. And having that all laid out so that when you're going out to market, that's going to help you a ton, is having all this data at your fingertips of how you're doing. So that's worth lots of data. Last one on this part is excellent preparation, right? So the most important part here is everything I just described takes a long time to implement. So just getting your if you go back to the S, scrubbed and clean, getting all your employment agreements and your vendor agreements and your leases and all of that stuff right takes a long time to negotiate. Building a bench of talent takes a long time to build, et cetera, right? So you really need to start this process of looking at these things and scoring yourself against how well you're prepared in each of these buckets a year or two before you are ready to go to market. And so the reality is the time is now to get going. And the last one is timing matters. And so we all know that we've been on a long economic run-up. The multiples that people are paying for companies is very, very high. We managed to sell at a couple of junctures that were really great, right? So 2007 was right before the Great Recession. And then we had again in 2017, we were at the tail, we thought we were at the tail end of a long run up, but here we are 3 years later, it's still going gangbusters. But there's other timing to think about as well. And the main one is a lot of the companies that get sold because they fall into a pit. They fall into a problem. And in the investment banking world and the private equity world, they call it the 5 Ds, the letter D. So those 5 Ds are death, disease, divorce, disenchantment, like you're just worn out, you've been doing this too long, and disintermediation, that somebody's coming into your marketplace and going to take out all the middlemen, somebody like Amazon and so on. So you want to be thinking about these things. What would happen if any of these 5 Ds happen to us, and what would happen to the value of our business? So pay attention to those things, and what's your backup plan around the timing that you might have. Some last key learnings here. Have a plan. That's the first thing, the most important thing. Share that plan with everyone. You've got to have a healthy team. Keep learning. And strength is the most important strength if you decide to either go to market or just raise capital to continue your growth plans, is don't be attached to the income. What you're after here is choices. Someone like Wayne was in the first picture. Make sure that you have somebody that complements your skill set. I'm a great visionary, but I'm a terrible implementer. So Wayne was my partner, and Wayne was great at implementing. The other part is lots of people that come to us for coaching, they say, I want to sell my company. I want to sell it for, I don't know, fill in the blank, $50 million, $100 million, $20 million, $1 billion, doesn't matter. But have a plan once you exit the business. I've watched a lot of people go off the rails when they sell their business and they're used to being master of the universe. And now the most important thing in the day is that their wife wants them to fix the doorknob on the bathroom door. It's a very challenging thing. And lastly, hire the best investment banker, attorney, and accountant that you can possibly afford. These people will make your money back by far as you're going through this process. Each one of those people made us millions of dollars in our transactions. And so that's the piece. If you bring in private equity, remember that they've got an end in mind. And so you're not going to change the game. They're going to have a very rigorous process that requires that you're going to be required to follow, which may or may not fit your personality. Worked great for us, but I saw it blow up in other companies that were in that same space. You got to have a lot of discipline, and don't expect that they know how to fix your business. They know how to do acquisitions and raise capital. They do not know how to run your business. All right, so that's it. That's my my talk. I'm open for questions. Eugene?
All right, thank
How
you
did I
very
do on time?
much. You did great on time, fantastic on time. Again, just a reminder for everybody who's still on to please post your questions. We do have a question that was just posed by Warren, who asks, what are some of your biggest mistakes made in business?
Okay, sure. So, God, the list is so long. I could go on and on, but I'll start with the first one was on the people side. There's a saying that you never fire anybody too early, which is very, very true. So I had partners and employees that I let stick around for too long. The not being disciplined about our processes, like, keeping stuff in my head versus building rigorous processes that made things work really well. Picking partners carefully. In some of those other businesses I talked about, not all of them were home runs. Several of them were pretty dismal failures or just singles and doubles. And in almost all those cases, that was due to partnership issues. So make sure you're careful with your partners.
Okay. You sort of at the tail end, you talked about how this is a long process, that if you're really looking to exit, it's something that you should be thinking about a year or even 2 years down the road when you
Yep.
start thinking about the Sparkle framework.
Yep.
In terms of the 7 steps, is there any one of them that you do first, or do you sort of focus on all
Yep.
of them simultaneously as you're going through that long process, or how would you even
Yeah,
start?
so the way we did it and the way that Riverside had us do it was focus on the biggest area of weakness for your business, which in most cases is number one, right? That you don't have a clean structure, right? You haven't, legally and accounting wise, it's a mess because that just stuff takes so long to get turned around and getting around it. And then the second one often is data. The Achilles heel of most small to mid-sized firms is they actually have no idea where they're winning and losing in their marketplace, and they don't have a lot of information about their marketplace. They use a lot of activity as their way of growing, and that works for a while, but it stops working the bigger you get. And so really getting good insight into what is your cost to acquire a customer? What is your cost to maintain a customer? We've had customers that and this isn't like a giant project. You can do your first step. The key is getting to unit economics. How many pieces does it take to get to the end? How much resources does it take to get to a happy paying customer, whether it's a one-time sale or a recurring sale? And most of that stuff you can do simple math on. If you've got 10 salespeople and you make 10 sales a year and each sale is $1 million, your cost per sale is easy to calculate. If you have 5 people in customer service and you're processing $5 million worth of business, right? For every $1 million in business, you need one person, and that person costs X. And then you can further divide it down into transactions. Most people are really unaware of what are the scaling factors in the business. So let's just say you're a $5 million business and you want to get to 10. Oftentimes, that isn't double the work, it's triple the work because you have to add so many more people. And if you're just doing it with raw, people to solve your problem, that the management overhead of those people, the saying goes that the complexity of your business goes up by the square of the number of employees, that just stalls you out and crushes your progress because it just gets so complex to manage this stuff.
Okay. Paul has asked a question that in your presentation you mentioned, I think in 2007, you went to market to recapitalize. And I think you mentioned that at that time you were about $7 million in sales.
We were about 12 million in sales and about 2 million in EBITDA at that time.
And so Paul is asking if you could talk a little bit about how that deal worked, and was that with a strategic investor?
Yeah, so it was not a strategic investor, it was a financial investor. That was when we brought in Riverside in 2007. And so I showed a picture earlier on. I attended a program called Birthing a Giants, which was put on by EO. It's now called the Entrepreneurial Masters Program. And it's still running today, which I highly recommend. And in one of the sessions, it runs for 3 years. In one of the sessions, the leader, which was Vern, brought in these 3 or 4 people who sold their company and told their story of what it was like. And from that, I realized we needed to get an investment banker, but we did have a business that we could get outside capital to grow. We had figured out with Vern from that 1998 to 2007 run how to scale the business and get it to 3 times industry profitability. And now we were ready to do acquisitions because we had built out those systems well enough that we could buy companies that were 1 times industry profitability, pay them 5 times to 10 times profits or EBITDA, but yet we were really buying, once we applied our system to those businesses, we were really buying them at 1 to 2 times EBITDA, which is a very easy math problem to grow the business on. And so we went out to market, said, we've got this dialed, look at our numbers, look at what we've done in other marketplaces, and now we want your capital to buy these other companies, put these systems and structures into place, and then scale them out. And so that's how we got all those bidders looking at the business. We hired a great investment banker, a great attorney, and they ran most of the process. The other part, which I didn't really call out much about having a partner, but the process of raising capital or selling your company is enormously time consuming. It's beyond anything you can imagine. And so Wayne and I were lucky that we had each other. And so Wayne took over some of the things that I was doing so I could answer a lot of the questions that were coming at us from these buyers. And Wayne was busy working, and I took some things off of Wayne's plate so he could work on gathering up the data on our systems and structures so that when we met with these buyers, we were able to answer their questions quickly and we had all the stuff at our fingertips ready to go. Hopefully that answered the question.
Warren has asked Rich whether what, if any, regrets do you have now that you've had a chance to look back on your career after a successful exit?
I don't have any regrets from the iAutomation one. That one was a total home run, and I have to say that it wasn't because we were amazingly smart. We were pretty smart, but we had great timing on our sides. That we were able to get access to capital. We were able to, we stumbled on EO and got involved with these programs and got a bunch of peers that we could learn from. And so I don't have regrets from there. I have tons of regrets going back in some of the earlier businesses that I started up and ran and when I go back and look at what made them blow up, I see all the reasons that I didn't do a lot of the things in this Sparkle presentation. We didn't pay attention to our records. We didn't have good agreements. We didn't have great partnerships set up. We didn't have a clear beat on our marketplace and how we were going to grow. And those were things that blew us up.
Rich, we have another question from Gus who asks, was your leadership team and or the A players in the organization aware that you were looking to exit? And if so, how do they support that plan and or hinder that plan?
That's a great question. So we were completely transparent about the process. So the whole time that we were building the business, we ran open book management. So we taught our employees how things worked inside the business. We gave them basic accounting training. So they learned how to read an income statement and a balance sheet and cash flow statements, partially because we wanted to push this knowledge down to the front line so that they could make decisions being fully informed of what's going on. I'm a big fan of Jack Stack and The Great Game of Business, which is an unbelievably awesome book that is about how to teach your employees how the game of business works so that they're able to make decisions. As a leader of a business, you win when the people on the front line would make the same decision you would make given the same set of circumstances or better without your involvement, right? So that was a big part of what Vern taught us and we were pushing down to the company. So everybody knew about that. They knew we were shooting for this 3 times industry profitability. Some years always hit 3. Some years we hit 4 or 5, but consistently we stayed above 3. And that was mostly because the team was thinking about, like, how do we do this? How do we do this? How do we do this? So they were fully aware of what was going on. When we brought in buyers to come view the company, we had about, I don't know, over a dozen people in that first cycle that came in. We did a little presentation for them in the room. And then we said, what we want you to do is, without us around, go walk around and talk to people. And remember, I talked about everybody had a one-page plan on their wall. They all knew why they were there, which was we wanted somebody to buy a chunk of our company and provide us with the capital and direction that we needed to get to the next phase. Every company has a life of leader cycle, and a leader comes in, they may be the one who starts it, or they may be somebody who comes in and buys it or inherits it or whatever, and then they're going to leave, whether they leave because they sold it, or they're going to leave because they can't run it anymore. One way or another, there's a cycle there. So we wanted to make sure that we kept that front of mind, is that this is the plan. So they were very helpful. The fact that everybody knew what the company's plan was and where we were going and what their role was in getting into it, and could tell the story about something I did this last 90 days. Here's the, if you look at the one-page plan, in the last column, there's 2 chunks. There's actually 3. One is, what are my personal metrics? What are the things that I'm driving personally, and how do they tie to the, what are the projects or priorities or rocks, depending on the terminology you want to use? What are the things that I'm working on to make this job easier at scale than it is right now? So for example, if it's a forklift operator, one of their things, their metric might be breakage, and another one is they're working on a project to, say, use RFID tags on all this stuff. And so buyers will walk around, they were blown away. Our little $12 million company was run better than most Fortune 500 companies, but it was just because we built this stuff in, and the ideas came from them. So they were very instrumental in us getting a very high value for the business. It's a little different if you're going to sell and exit, in the sense that you have to think through how this is going to play out. But anybody who's trying to sell the company at the detriment of the employees, on the backs of the employees, that they're going to get screwed, is probably heading for trouble anyway in this process. There isn't a good way to do that I've ever seen.
Rich, that's actually an excellent segue into the last question that I see here from Renee, who asks, who says that he keeps being told not to worry about who buys his company, yet he feels that he owes something to his customers and his employees that have stayed with the company for 20 years. So thoughts about that?
Yeah, I 100% agree. I don't think that you can, there's the very small minority of deals where people get a really good outcome from selling their business to someone who is going to be evil to their customers or to their employees. That's a tiny, tiny percentage of the deals. Most people are trying to buy a company that is valuable because they have customer relationships and because they've got great people on their team that they can leverage into the next level of this business. They can be the next leader that takes this great thing you've created and multiplies it, makes it bigger. That is the name of the game for private equity. And most strategic transactions are the same. They're like, are they looking for some synergies? Sure, right? There's definitely not going to have redundancy all over the place, but that's going to happen anyway, no matter how you scale the business. So there isn't too many deals where you have a home run for the owner and everybody else gets screwed that works out well for anybody.
Fantastic.
And your options are much bigger if you have a great company with great employees. All your stuff is clean and scrubbed. You've got lots of data about who you are, where you're going, where you make money, what areas you're going to stay away from, and a clear outcome in mind of where you want to go. That will drive. I'll give you a much larger selection of people to bid against each other for your amazing property that you built.
Great. If anybody else has any questions, we'll leave it open just for a few more minutes. Please post those questions to the chat. We'll see if anybody has any more, Rich. I think that might be all of them, and we're running up against the hour. So I want to, again, obviously thank everyone for attending today's webinar, and certainly a big thank you to you, Rich, for a great presentation and a lot of information. If any of you have any questions about Align or the Scaling Up Scoreboard as a tool that you can use to sort of be all in one page, have all that data, and to sort of be better at executing on your strategic plans as you work towards an exit, please don't hesitate to contact us. And certainly, thank you all for joining us. Please mark your calendars for our next coach webinar, which will be on March 25th, when business coach Dr. Craig Overmeyer of Cultures That Work will present on the missing strategic conversations, how to accelerate your business flywheel through productive conflict. So it should be a very interesting discussion. Hope you'll all join us then. Until then, we all hope you have a great week, and thanks again for joining us.
Have a great day. I'll send out those links to you to distribute to anybody who attended too.
Great. Thank you so much.
Bye-bye.